Hello, this is Japanese Economic Review Channel. So I want you to imagine the absolute biggest star on a basketball team, right?
Okay.
Like the player who has been scoring, I don't know, 90% of the points all season long, and suddenly they get benched.
Right, which is usually a disaster.
Exactly.
Yeah.
By all logic, the team should just completely collapse. But instead, they start winning by an even wider margin.
Yeah, it's wild.
It's a bizarre paradox, but that is exactly what we are seeing play out in the Japanese stock market right now.
It really is.
So today we are doing a deep dive into the officially published weekly domestic market outlook. And this covers the really critical week of July 6th through July 10th, 2026.
A very busy week.
Super busy.
Okay.
And if you hold a portfolio or, just follow the macro economy, you really need to understand the underlying mechanics of what is happening this week.
Absolutely.
Because we're going to unpack this strange market resilience, despite some pretty severe wobbles in the tech sector. Plus, we'll break down the yen's historic, wildly volatile swing to a 39.5-year low.
Which was just crazy to watch.
Oh, completely. And finally, we will preview the massive structural catalysts that are waiting for you in the week ahead.
Yeah, and it is one of those weeks where the surface level statistics could easily mislead you.
How so?
Well, if you just read the headlines, you would assume we're on the verge of this massive tech-led correction, like the whole thing is coming down.
Right.
But when you dig into the published volume data and you see where the institutional capital is actually flowing, a completely different narrative emerges.
Okay, well, let's get right into those published statistics then. So the Nikkei 225, it closed the week at 69,744.07.
Right.
And to put that into perspective, that was up over 1,000 points on the final trading day alone.
Massive jump.
Yeah, finishing up 383 points for the week overall.
Yeah.
And the official outlook is projecting a trading range for next week of somewhere between 67,800 and 71,800 yen.
Which is a pretty healthy range.
It is. But the metric that really jumped out at me from the report was the broader TPX index.
Oh.
It saw what the official data literally calls a clean sweep of games, closing at 4,064.60.
A very strong showing.
Right, but I have to push back on the optimism here just a bit.
Sure, go ahead.
If the AI sector, which, let's be honest, has practically carried the entire global economy on its back for the last year, if that is stumbling, how is a TOPIX clean sweep not just a temporary illusion before a wider market drop?
I mean, that is a very natural reaction. When the engine sputters, you expect the train to stop.
Right.
But the mechanics of institutional investing, they just don't work like retail trading.
Yeah.
Like large pension funds and asset managers, they don't just liquidate billions of dollars into zero yield cash the second a sector looks overvalued.
They can't, right?
Exactly. They have mandates to stay invested. So what we are witnessing in the statistics is this massive, highly strategic rotation.
Okay.
The report actually refers to it as a trickle-down effect.
A trickle-down effect. Usually, we hear trickle-down in the context of tax policy, not stock market mechanics.
Right, yeah.
So walk me through how capital physically trickles down in this scenario.
Think about the massive run-up we've had in what we call the pickaxe stocks of the AI gold rush.
Okay, so the hardware guys.
Exactly. The semiconductor manufacturers, the specialized infrastructure firms, the power companies that feed the data centers,
Right.
they became incredibly expensive, basically priced for absolute perfection.
Yeah.
And this week, some rumors hit the wire, which we'll discuss in a second, and those tech stocks wobbled. But the capital didn't flee the Japanese market.
It just moved.
Right. Instead, portfolio managers took their massive profits from tech and mechanically reallocated them into cheaper, more traditional sectors.
Like what?
Industrials, financials, real estate, things that haven't pumped yet.
Oh, I see. So it isn't a retreat driven by panic at all. It is a search for value.
Exactly.
The money is basically saying, okay, tech is priced for a flawless future. Let's go buy some banks that are actually cheap right now.
That is the core mechanism. And honestly, it demonstrates an incredible underlying resilience in Japanese equities.
How so?
Well, if a market relies entirely on one thematic narrative, like AI hardware, it's fragile. It has this bubble mentality.
Right.
But a market that can absorb a shock to its biggest star and simply shift the capital to its supporting cast, that shows a structural health that foreign investors just love to see.
Cool. That makes the mechanics of the TOPIX surge much clearer. But it brings us right back to the obvious follow-up question.
Why is the star player stumbling?
Exactly. We need to look at what specifically spooked the AI and semiconductor sectors this week.
Yeah, it's important.
Because the official outlook details three very distinct headwinds, and they seem to strike at the absolute core of the tech narrative.
They do. There's been a distinct shift in market psychology lately. We are moving from this blind euphoria to basically recognizing that building out global AI infrastructure is a chaotic physical manufacturing process.
Not just a software update you can download.
Exactly. It's real-world physics.
Well, let's take these headwinds one by one, starting with the hardware side. The report highlights mounting anxieties regarding the yield rates for NVIDIA's highly anticipated next-generation Rubin chips.
Right.
Now, for those of us who don't spend our time inside a silicon fabrication plant, why is a yield rate such a terrifying metric for investors?
Because it dictates the basic physics of profit.
Okay.
Semiconductor manufacturing is arguably the most complex manufacturing process in human history.
I mean, they're printing microscopic circuits onto silicon wafers.
Exactly. And the yield rate is simply the percentage of chips on that wafer that actually work perfectly and can be sold.
Okay, so if I bake a batch of 100 incredibly complex cookies and 40 of them just burn or fall apart because the recipe is so difficult, my yield rate is 60%.
Yes,
Yeah.
exactly. And imagine each of those ruined cookies cost you tens of thousands of dollars in raw materials and energy just to bake.
Oh, wow. Okay.
That is the reality of next-generation chips, like the Rubin architecture. So when the market hears rumors that a foundry is struggling to get the yield rates up, it means two things mechanically.
Which are?
First, the supply of these critical chips is going to be severely bottlenecked. And second, the profit margins are going to be completely squeezed because so much expensive silicon is basically ending up in the trash.
Right, because the market had already priced in a flawless rollout, and physics is reminding them it just isn't that easy.
Precisely.
Which instantly deflates those crazy revenue projections.
Yeah.
Now, the second headwind highlighted in the outlook seems almost counterintuitive to me.
Okay, which one?
It notes that OpenAI is introducing new technologies designed to drastically reduce computational costs.
Right, the software efficiency side.
Yeah. And on paper, making AI cheaper to run sounds like a massive breakthrough for the industry. So why would that cause tech stocks to wobble?
Well, it is a massive breakthrough if you are a software developer building AI applications. But you have to look at who has been driving the stock market rally.
The hardware sellers.
Exactly. The companies selling those expensive pickaxes.
Ah, I see the tension now. If the gold miners suddenly figure out a way to dig the same amount of gold using half the pickaxes, the tool salesman is going to take a huge hit.
You hit on the underlying vulnerability of this entire rally.
Really?
Yeah, the whole valuation model for companies like NVIDIA or, the server builders, it assumes this endless, insatiable demand for raw computing power.
Right.
So if the software models become radically more efficient, you simply don't need to buy as many servers to run them.
Wow.
A breakthrough in software efficiency is an active threat to hardware revenue projections.
Okay, so we have physical manufacturing limitations on one side and
right.
software efficiency threats on the other.
Yep.
But the third headwind is purely geopolitical.
Ah, yes.
The report notes rumors that Apple is considering using Chinese-made memory chips in its devices. If that's true, that feels like a tectonic shift for Western hardware dominance.
It certainly grabbed headlines, but we really have to apply some critical historical context here, which the official data actually helps us do.
Okay.
Think back just a short time ago to the absolute market panic surrounding the release of DeepSeek.
The low-cost Chinese AI model.
Exactly.
I remember that vividly. The prevailing narrative was that DeepSeek was going to commoditize AI overnight, completely wipe out the competitive advantage of Western tech giants, and just crash the sector.
And look at the statistics now. As the report implicitly points out by looking at the broader trend, the market absorbed that shock and just moved on.
Right.
The initial panic faded once engineers actually looked under the hood and realized the implementation realities. Geopolitical tech rumors almost always trigger an immediate algorithmic sell-off, which is then followed by a rational reassessment.
Plus, practically speaking, it seems highly improbable that the U.S. government in 2026 would passively allow a flagship American company like Apple to mass procure critical semiconductor technology from Chinese state-backed firms without, massive regulatory intervention.
That is the reality check the market is currently processing.
Yeah.
When you combine all three of these headwinds, what the volume data suggests is not an apocalypse.
Correct.
Institutional investors aren't abandoning AI forever. They are simply moving into a wait-and-see holding pattern.
Got it.
They've parked their capital in the TOPIX value stocks, hovering on the sidelines, waiting for the dust to settle on these rumors so they can buy back into tech at a cheaper valuation.
That perfectly explains the stock market rotation. But while equities are taking a strategic pause, the currency markets are experiencing violent volatility.
Oh, absolutely wild volatility.
Yeah, the macroeconomic forces causing institutional funds to rotate their portfolios are also wreaking havoc on the yen. Let's look at the USD-JPY timeline from the report because we need to pause on this number.
It's a big one.
The dollar surged to 162 yen.
Yeah.
That is a massive 39.5-year high. We haven't seen those levels since the mid-1980s.
It's historic.
But almost immediately, by July 2nd, the yen sharply snapped back into the 161 range. So, break down the mechanics of what drove it that high and then what caused the sudden reversal.
Okay, so the surge to 162 was basically driven by the raw mechanics of yield differentials.
Okay.
Currency valuations between developed nations are largely dictated by interest rates. In the United States, early economic data suggested inflation was sticky, meaning the Federal Reserve would keep interest rates elevated for a longer period.
Right, and if U.S. bonds are paying 5% and Japanese government bonds are paying a fraction of a percent, global capital is going to mechanically flow out of Japan and into the United States to capture that yield.
It is an unavoidable gravitational pull.
Yeah.
And at the same time, expectations that the Bank of Japan would aggressively hike rates started to fade.
Yeah.
So the yield gap widened and the dollar just crushed the yen.
Right.
But then, as you mentioned, we hit July 2nd, and the narrative abruptly fractured due to two opposing forces.
What were they?
First, the finalized U.S. June employment statistics came in remarkably weak.
Which instantly changes the math on the U.S. side. Real job growth means a cooling economy, which means the Fed might actually have to cut rates sooner than expected.
Exactly. That caused the U.S. dollar to lose its upward momentum.
Okay.
But the second, arguably more aggressive force came domestically from Japan. We saw intense, coordinated government intervention warnings.
Yeah, the outlook specifically points to comments from Ministry of Finance officials and the publication of the Honobudo Economic Guidelines.
Right.
Now, for those who don't read Japanese fiscal policy documents recreationally, why do these guidelines have the power to actually move currency markets?
Well, the Honobudo Guidelines serve as the overarching blueprint for Japanese government policy.
Okay.
And what was critical this week is that they contained explicit language highlighting the negative impacts of a weak yen on domestic households,
Wow.
which effectively puts political pressure on the Bank of Japan.
Let's unpack the mechanics of that pain, because I think it's vital. A weak yen sounds like it would be great for Japanese exporters like Toyota. But how does it hurt the average family in Tokyo?
It comes down to imported inflation.
Okay.
Japan imports the vast majority of its energy, its oil, and its food. And those commodities are priced globally in U.S. dollars.
Right.
So when the yen plummets against the dollar, the cost of a barrel of oil in yen skyrockets, even if the global price of oil hasn't changed at all.
Wow. Okay.
That instantly translates to higher electricity bills, higher gas prices, and way more expensive groceries for households without any corresponding increase in wages.
So the political pressure just becomes immense.
Huge.
To use an analogy, it's like the currency market this week was a massive tug-of-war.
Yeah, that's a good way to look at it.
You have the U.S. economy pulling the rope hard with high interest rates, and Japan is losing its footing. But suddenly, the U.S. jobs data comes in weak, so they kind of drop their end of the rope.
Exactly.
And at the exact same moment, the Japanese Ministry of Finance steps in and yanks the rope back with aggressive intervention threats.
And the result is that violent snap back to the 161 level.
Right, that captures the volatility perfectly.
Hmm.
Both the fundamental macro data and the political posturing collided on the exact same day.
They really did.
So looking forward, the published outlook projects a very tight trading range for the upcoming week, right? Between 160.00 and 163.000 yen of the dollar.
Yep. And that 163 level is functioning as this invisible barrier.
How so?
The market psychology has determined that if the rate breaches 163, the Ministry of Finance will move from just verbal threats to physical market intervention.
Meaning they actually step in.
Right, dumping U.S. dollars from their reserves and buying yen in massive quantities to artificially strengthen it.
It's like an electric fence.
Oh, yeah, exactly.
Currency speculators can graze right up to 162.9, but if they touch 163, they know they risk getting zapped by billions of dollars in government intervention.
And that fear of intervention is the primary force keeping the currency range-bound right now. It's preventing a further slide.
Wow. Okay, so we have Tech stocks wobbling over yield rates, the broader market rotating into value, and a currency market trapped between U.S. data and Japanese intervention threats.
It is a lot to track.
It is. So if you are navigating this landscape, how do you
Yeah.
prepare for the week of July 6th through the 10th?
You look at the data.
Right. And the official timetable lays out several major catalysts. I want to start with what sounds like a massive red flag.
Okay.
The report notes that on July 8th and 10th, ETF settlements will trigger an estimated 1.7 trillion yen in technical selling.
Right.
To a casual observer, 1.7 trillion yen in selling sounds like the catalyst for an outright market crash.
And this is exactly why looking at the underlying mechanics is so crucial.
Yeah.
We need to be explicitly clear here. This is a mechanical administrative event. It is not a change in investor sentiment.
Okay.
It revolves around exchange-traded funds or ETFs and how they pay dividends.
So break down the plumbing of that for us. How does an ETF physically generate that cash?
Well, an ETF is essentially a basket that holds shares of hundreds of different companies.
Right.
And many of those underlying companies pay cash dividends to their shareholders. The ETF collects all those disparate dividends and needs to distribute them to the people who own the ETF.
Makes sense.
However, to generate the massive amount of physical cash required to pay out those dividends simultaneously on settlement day, the ETF managers must mechanically sell a tiny fraction of the underlying stocks they hold.
Oh, I see. It's a pre-programmed administrative chore.
Exactly.
The market makers, the algorithms, the institutional funds, they all know this date has been on the calendar for months.
Yes, the liquidity is already prepared to absorb that 1.7 trillion yen.
Right.
So, if you are watching the market on July 8th or 10th and see a sudden spike in sell volume or a momentary dip in prices, do not mistake it for a panic sell-off.
It is simply the plumbing of the financial system functioning as designed.
Spot on.
That is vital context. Now, on the very same day, July 8th, there is a catalyst that could actually provide a massive tailwind.
Yeah.
The IMF is releasing its World Economic Outlook, and the report notes that if Japan's growth is revised upward, we can expect a surge in foreign buying.
Oh, absolutely.
But why does one report from the IMF trigger automatic buying?
Because massive global institutional funds, sovereign wealth funds, complex trading algorithms, they often use IMF structural data as a foundational input for their asset allocation models.
Really? Just plug right in.
Right. If the IMF signals that Japan is structurally improving, it essentially gives these multi-billion-dollar funds the algorithmic green light to increase their weightings in Japanese equities.
Wow. Speaking of algorithms and foundational data, later in the week we get the release of the U.S. Federal Reserve's June FOMC minutes.
Yes, very important.
And the outlook specifically highlights the new Fed chair, Kevin Warsh, and notes he is introducing a uniquely flexible but unpredictable style.
Yeah, he represents a total paradigm shift from previous Fed chairs.
How so?
The report points out that Warsh is actively dismantling forward guidance.
Oh, wow.
He just refuses to give the market a step-by-step map of what the Fed will do with interest rates over the next 6 months. He has even eliminated the famous dot plot projections.
And Wall Street absolutely disguises that because institutional trading models rely on certainty to price risk over a 10-year horizon.
You've isolated the exact friction point.
Yeah.
The algorithms want a predictable path. Warsh is forcing them to fly blind, insisting that the Fed will only react to incoming real-time data.
Okay, but what is his baseline?
The one constant he has communicated is a fierce anti-inflation stance.
Got it.
So when those minutes drop, analysts will be parsing every single sentence to see what the Fed's internal threshold for inflation actually is.
Right.
Any hint that they think inflation is sticky could trigger algorithmic sell-offs in both U.S. and Japanese equities.
Okay, so we have a Fed chair refusing to show his cards. But the ultimate reality check for this entire week, and honestly, maybe for the entire quarter, comes late next week with the release of the TSMC June sales report.
The big one.
Right. TSMC is the Taiwan semiconductor manufacturing company. They are the foundry that physically prints the chips for NVIDIA, for Apple, for everyone.
Exactly.
Why is this specific monthly revenue report the linchpin for the global market right now?
Because it cuts through every single narrative, rumor, and anxiety we discussed in the first half of this deep dive.
All the noise?
All of it. All the panic about yield rates, all the fear about OpenAI compute costs slowing down hardware demand. TSMC's sales report is pure, unspinable physical data.
It is the ultimate referee checking the scoreboard.
Precisely. If TSMC reports a massive revenue beat, it proves that physical demand for AI infrastructure is still insatiable.
And the fears disappear.
Right, all the anxieties will evaporate and capital will flood back into the tech sector. But if TSMC misses expectations, it provides hard numerical proof that the tech wobble was justified.
Wow.
And if that happens, the defensive rotation we saw into the TOPIX this week will rapidly accelerate.
It is going to be an incredibly tense week of trading. So what is the one key takeaway you want to leave everyone with as they monitor these catalysts?
Look at the broader transition happening beneath the surface of the statistics.
Okay.
For the past 18 months, global equities have been driven almost entirely by the potential of AI. Companies saw their valuations skyrocket simply by promising future integration.
Right, selling the dream.
But this week's rotation out of tech and into traditional value stocks indicates a massive psychological shift. We are transitioning from a market of potential to a show-me-the-money market.
I like that. Show me the money.
Right. Investors are no longer willing to pay infinite premiums for a story. They are demanding tangible, physical revenue.
Yeah.
And the depth of the Japanese market is shining right now because it is full of traditional companies generating real profits. When TSMC's numbers drop, we will finally learn if the AI sector's actual cash flow can support the narrative that has kept the global economy afloat.
The diagnostic muddy waters are finally going to get a crystal clear X-ray. It is going to be fascinating to watch how the capital flows.
It really is.
Thank you for watching the Japanese Economic Review. We look forward to having you with us again.